Joining us now for more on the markets and what the implications are. Today, Todd, Fiduciary Trust International Executive Vice President and Head of Regional Markets. Good to see you, sir. All right, look into your crystal bull. I think I made that up. I'm not sure, but crystal bull is going to be mine. What does tonight/tomorrow mean for the markets moving forward?
Boy, it's going to be hard to predict. So here's what we think, and you've been talking about it all day. It looks like we're going to see a situation where the House goes to the GOP. And the Senate is still tough to call, but I think the probability is rising that that also goes to the GOP. May not know tonight, may not know tomorrow, may take a week or two to sort out. But you're going to have a situation where you have a divided Congress and maybe a divided government. And I think historically that causes gridlock, and gridlock is going to be pretty good for the markets. I think gridlock means that the economy can still grow. I think gridlock means that inflation probably will be a little bit lower, and I think yields will be lower. So I think that's why we've seen the market rally today. It was up yesterday. You flashed some great statistics. On average, from the midterm elections through the first year, you see the stock market go up about 18%. So people are feeling pretty good. I do want to caution people, though, this may be different this time. We could be going into a significant slowdown. I mean, we've got the Fed that continues to raise rates. We've got a Fed funds rate that's 4, and everyone's talking about a terminal rate that's at least 5, maybe 5.25. So we've got a ways to go, and rising rates has consequences. It will slow down the economy. We're starting to see that now. So I'm a little bit nervous about the economy slowing down. I'm a little bit nervous about what that means to corporate earnings. I think they're still too high. And so I know history is on our side with the markets rallying over the next year, but this year could be different.
Gene, I'm curious, going back to what you just said a minute or so ago, when you said gridlock could mean lower inflation. Why?
Well, I just think that some of the policies that we've seen the Democrats try to shoot for absolutely are not going to happen. So we don't think that under a divided government, you're going to see some of the stimulative policies that can tend to accelerate inflation.
And Gene, I want to talk about some of this uncharted territory. In your notes, you say that we've never had an economic recession in the third year of a presidential term. How do people prepare themselves for this uncharted territory when it comes to their portfolios?
Well, I think it's going to continue to see a lot of volatility. We've seen it all year. I think it's going to continue. But there are things that people can do. So as a firm, we're a bit underweight equities right now. But there's areas that we like. I mean, we love energy. Energy has been a tremendous performer this year. We love the supply-demand dynamics. We're going into winter. We've got a rational OPEC finally. And so we think oil stays relatively high. We think the energy companies still outperform. They've done it thus far this year. We think that they'll continue. We like healthcare. Healthcare has been a good performer. They had a good Q3 earnings reporting period thus far. That's going to continue. And healthcare, there's just so many positive things going on right now. We've got an aging population. No one's getting any younger. And there's just been fantastic advances around oncology, diabetes, Alzheimer's. So that's a sector that we like. Getting away from equities, fixed income. I know that's been a dirty word for the majority of this year, but you're finally seeing very attractive entry points in the fixed income, particularly if you're looking at low duration, very low risk. You can get yields that have a 4 on. So that's a pretty attractive entry point. So fixed income, don't sleep on that. There's some sectors that we like in equity. And the last thing I'll say is alternatives. Alternatives used to be talked about for institutional investors, for family offices. there's a role for them for most investors. There's some absolutely unique opportunities to get better diversification, increased alpha, and a lower correlation with stocks and bonds. And so private equity, private debt, private real estate, huge opportunity there.
Well, there you go, a whole checklist of opportunities to be on the lookout for. Gene, Todd, thank you so much for joining us this afternoon.